optimization. The software is one of the fastest growing trading systems on NinjaTrader. It's now my pleasure to introduce our special guest presenter, Mark Sachs, founder of Rightline Trading.
Thank you so much. Thank you so much, Darla, for that. Um, excuse me, for the really nice introduction, and thank you for hosting me here today at Trader Planet. And you really mentioned my background, but I'm a graduate of the University of Pennsylvania, a former professor at Jefferson University in Philadelphia, and I've been involved in the financial markets for over 20 years. And I began trading the futures and forex markets about 10 years ago. And I've been involved in the optimization of software systems for the last 10 years via mathematical modeling. And you can find us at www.rightlinetrading.com. Now, actually, I'm just going to go ahead and skip that. And I just really want to start off by saying it's really important that excuse me very much, excuse me, each of you out there understands um, what each indicator does. Now, everybody knows that a stochastic oscillator uh, traces out a line that tells you overbought and oversold conditions. But if you don't really understand the mathematics of the oscillator, then it can be placed in a software package and sold to you in a manner which it doesn't work. Take for instance when a stochastic oscillator is placed in a software package with Renko bars. Now, if you look at the math of the oscillator, you see that you need three numbers in order to calculate the percent K, and that is the relationship between the high and the low of the candle and the close of the candle. If you don't have those three numbers, the percent K line will not trace out appropriately. Now, if you look at a range bar chart, you can see that you have, and I'm hoping that you can see my pointer. You can see the high and the low, and actually the open and close of every candle, so that the percent K line is tracing out fine. But if you look at a Renko chart, you can't see any of that. So the percent K line is simply mimicking the the price structure you see on the chart. So any package that uses an oscillator and Renko bars to try to show you uh, buy and sell recommendations based on software analysis is not going to provide you with accurate data. So that's part of the due diligence. And I always recommend a book to everybody at the outset, and it's called Trading for a Living by Alexander Elder. You can get it on Amazon for about $10, and it's really a wonderful book. And Alexander Elder wrote it in the 1990s before the advent of any electronic trading. And what he does is he goes through a nice um, sort of non-mathematical description of how each indicator works and what they're for. And Alexander Elder is the inventor of the triple screen method, which is essentially how we modeled our software package. So you really learn a lot from that book. And I have a bookcase full of books, and most of them I have bookmarkers in like halfway through where I kind of gave up on them. But his book is just wonderful. So it's Trading for a Living. Now, there are just a few basic underlying strategies that software developers take when they look to develop a program to define market direction. Now, there's some people that believe that price action is enough to trigger a buy and sell recommendation with a predictive value high enough to make you profitable. Essentially, what you're doing is you're looking for sensitivity, specificity, and from sensitivity and specificity, or actually sensitivity over specificity, you get a number that's called the positive predictive value. The positive predictive value is essentially a percentage, and that tells you what percentage of the buy-sell recommendations are going to be successful or lead to a successful outcome. Now, they believe that price action alone is enough to provide you with that kind of predictive value. Now, now other software developers believe that indicator analysis, or some unique composition of indicator signals or confluence of indicator signals, trigger a buy sell recommendation, again, with a predictive value that's high enough to make you profitable, to get you to your first target, make the trade successful. And a further subdivision are those that trade one time frame and those that use higher time frames to confirm the validity of their entry. Now, those people, that type of analysis, multi-time frame analysis, is known as fractal analysis. Now, we at Right Line Trading sort of reject and also embrace all of these hypotheses. We believe that price action does not provide you with low risk, or saying it another way, entries with a high predictive value, significantly high enough to get you into a trade, although we believe that price action comprises about 80% of the information that's required in order to provide you with that kind of trade. We also definitely do not believe that any confluence of indicator signals, the buy on the blue dot, sell on the red type of system, is ever going to make you profitable. In fact, if you've been in this, if you've been a professional day trader for a number of years, or you're looking to get into day trading, you're going to see quite quickly that any system just simply based on a confluence of indicator signals is never going to do it for you. Now, if either of these were true, then the financial markets could be robot traded and someone could make millions of dollars of profits. I mean, by now, a computer could have discovered what confluence of indicator signals were successful, say with a predictive value of 90% or greater, and simply robot trade the market, and nobody has ever been able to do that. So what we do is, the goal of Right Line is to combine really the three major components and embrace them all, reject them all as being standalones in terms of trading, but embrace them all by integrating them all into the software package. So we believe that market structure is extremely important, indicator analysis is extremely important, and we believe that multi-time frame analysis or fractal analysis is extremely important. And what we've done is we've integrated all three of these components into a trading platform that's been optimized mathematically to provide you with remarkably accurate trading entries. Now, the thing is that when I'm in other webinars, one thing that I'll constantly ask the presenters are, well, what's the positive predictive value of your trade? Does your system very sensitive, or is your system very specific? And rarely do I get an answer. And the reason I don't is because their software systems have not been analyzed mathematically. And essentially, before I go on, I just want to say very briefly, basically what a trading system really is a series of independent variables. And the components, or what those independent variables are components of market structure, components of indicator analysis, components of multi-time frame analysis. And what you have to do is take the multivariate equation that you set up. And obviously the multivariable equation is key, because the parameters that you believe that act as independent variables and ultimately coming up with an entry that has a very high predictive value is kind of like, to give you an example, it's like you want to bake a cake. Well, before you can even start baking it, you have to decide what ingredients are going to go in order to provide you with a really good tasting cake. And then optimizing each independent variable individually and that's baking the cake to provide you ultimately with an outcome or a predictive value that's extremely high. That's what we've done at Rightline. We've done the platform on a mathematical basis, not just sort of a throw it all together and guess and not know the sensitivity and specificity of our trading entries. And this is really a key component to making a successful software program. And without it, you're left with a bunch of guesswork. Now, at Rightline, we do not call tops or bottoms. Now, if you understand what indicators do and how they work, and you read Trading for a Living, you will see that, in my opinion, and listen, there are a lot of right ways to do things and a lot of wrong ways to do things, and by no means would I ever say that I have the only right way to do it. I do not believe that any indicator can call a top or a bottom. I mean, we constantly see as we trade, I'm going to show you, people calling tops and getting run over in unidirectional markets, calling bottoms and getting run over time after time after time. So we don't trade reversals. We trend trade. Now, we don't counter trend trade either. We believe that the institutional people with all the money create the trend, and so we don't buck them, and we don't try to counter trend trade. These are all kind of variations of the same thing. A counter trend trader is going to try to trade reversals. Counter trend trader is going to try to call a top or a bottom. We don't do any of that. And also, we don't try to and predict breakouts. And now, if you look at indicator analysis and you try to predict if the market is going to continue on based on indicator analysis, it just doesn't work. So software that predicts a breakout, say based on some percent movement of the average true range, is never ever going to make you profitable. So what we are is we are trend traders only. We look for the software to define a trend, and we want to get into that trend early. And as I mentioned earlier, it's the institutional traders that set the trend. And we want to be on board with them, and it's our goal to define that trend early, get on board fast, and get on board safely. Now let's take a look at, this is a range bar chart, and I like to trade range bars, although our system works on any charting, any kind of candle, works on time, tick, and since we don't use an oscillator, and I'll tell you why, it also works on Renko bars. But if you see here, and I don't know if you can see my pointer, you can see that this is an engulfing candle, and it's almost at a low pivot, and this predicts a market reversal, and it works very successfully. But other than that, and I've read all of Steve Nissen's books on candlestick formations. I think that they just don't give you they give you excellent information. Don't get me wrong. I mean, a candle without a wick tells you that there's a lot of selling or buying pressure. A lot of sellers and buyers are piled into that candle. I mean, there's definitely information to be obtained from a doji, but I just don't think it provides you with sufficient information in order to trade profitably, and that really is the key. Is there enough information present in price action / market structure to make you profitable? And it's my personal opinion that there is not. So what we do is we look to define the market, and we look to break it up in terms of a little more in terms of price structure. Now, this is just simply a 50-period moving average. And we believe that the bulls are in control when price is above, and bears are in control when price is below. So we only go long when the price is above, and we only go short when price is below. Now, if you see this move up, we consider this a counter trend trade, and we don't take them. This fall here in the buy zone is a counter trend trade, and we don't take them. We only go long above, short below. And we trade with an incredibly high degree of specificity. There are a lot of moves that go by and we don't get them. But if you trade with a lot of sensitivity, looking to capture every single major market move, you're going to pull in a lot of losers. Because if you trade with sensitivity, it's a mathematical mandate that if you're looking to get a lot of true positives, you're going to pull in a lot of false positives. And those false positives are going to be the trades that stop you out. If you trade with a lot of specificity, where you look for true negatives, and that's what we look for. We want to look for for all of the trades that really don't make it. So we don't look for the true positives, we look for the true negatives. We want to filter out the losing trades. Because let me tell you something that you will see as your trading career goes on. It is never about the number of winners. It is always about the number of losers that you take. So you really want to trade with a high degree of specificity. Now, in order to help us trade, we have what is known as our modified 15. It's a 15-period moving average, but it's been modified significantly for stability. If you put a 15-period exponential or a 15-period simple over it, you're going to see they crisscross. And when the line is yellow, we don't trade it because that defines chop. And this saves us from an enormous number of losers. Remember, that's what we're looking to do. Filter out the losers. If we do, we will capture the winners. Now, again, there are some trades that'll slip past us, some that go 25 or 30 ticks, but that's the price you pay for filtering out all the losers. We only go short when the 50 and the modified 15 are red. We only go long when the 50 and the modified 15 are green. We need the 15 below the 50 for a short. We need the 15 above the 50 for a long. We also believe that pivots are important. We never trade into an unbroken pivot. We have a very unique pivot indicator. It breaks when 2/3 of a candle body closes below it or 2/3 of a candle body closes above it. If we don't have space between our first target and our entry, we don't take the trade. Now, sometimes the pivot breaks, but we can never tell when it will and when it won't, and therefore we never trade into unbroken pivots or into trend lines. Now, as part of our multivariable equation, we have determined that the number of ticks a candle is away from support or resistance helps determine the positive predictive value of the trade, and we're looking to optimize that. So we created an indicator that tells you how far the candle is away. This is the modified 15. This is the candle open. This is a 7. And you'll see it in our software. We're going to move over to the software fairly quickly. And if this number is more than 4, it means you're too far off support to the upside or off resistance to the downside to take a trade. Now what this does is it defines risk. You want every parameter that you possibly can, that you think is important to taking a successful trade defined by the software. Now, if support is 7 ticks off the candle body open, there's always a chance that the trade is going to come back to support instead of continuing up in your direction. So these are the kind of trades that we let go. Some of them just continue up, but again, it's not about catching all the winners. It's about filtering out the highest percentage of losers as possible. Now, in terms of indicator analysis, we believe that there are 3 things that are important. Order flow and momentum are the key indicators, besides moving averages, which are indicators, in order to take a trade. Now, stochastic is our middle line of our 3-line indicator. This is really the workhorse of our indicators. And line number 1 is order flow, line number 2 is stochastic, and line number 3 is momentum. Now, it does fractal analysis. So when order flow is down on all time frames, it's red. Stochastic on all time frames or momentum down on all time frames, you get a red. When any of these parameters are up on all time frames, it's green. When you're up long term but short down term, it's blue. And when you're down long term and short up term, it's orange. But you don't have to worry about any of this because all this data is projected directly onto the price bars. So you don't even have to look at the three-line indicator at all. Now, I'll just tell you something interesting that we found in doing our statistical analysis. I mean, it's never been done before, but stochastic in no way increases the predictive value of the trade. And if you think about it, there are two schools of thought about stochastic, and that is when it becomes overbought, it tells you that the bulls are in control. And traders are told to continue to buy as each high pivot is broken. So you continue to go long into an overbought market where bears are running the show, bulls are running the show, and to continue to short into an oversold market where bears are in control. The other school of thought is you look for stochastic divergence and look for a reversal. Now, half the people say to do one, and half the people say to do the other. And who is right? And the answer to that, and we looked at a year of market replay data and determined this on a statistical basis, is that they're both right and both wrong. And the fact is that if the stochastic is in your favor on the trade, it adds nothing to the predictive value of the trade. The only reason we even bothered to leave it in is because it's part of the three line. The data is projected onto the price bars, and in no way does it encumber or make it more difficult to analyze our trades. And maybe at some point in the future we'll find a use for stochastic. But as we stand now, at least as far as I'm concerned, trading with a stochastic adds absolutely nothing to the trade. Now let's take a look at actually how the market works, or how our software works. You can see here, in fact, let me go to the next slide. You can see here that the three line is all green, but it's tough to look at it. Remember, it's calculating intra-bar and constantly changing. So what we do is we project the information onto the price bar, and it does this intra-bar. So when you see the candle intra-bar start flashing this blue halo, you know that order flow, stochastic, and momentum are with you on all time frames. Now, when it breaks the 50 and the modified 15 is green, you have an uptrend. 50 is green, modified 15 is green. You break the 50 with a 2/3 candle close. The candles outlined, order flow, stochastic, and momentum are to the upside on multiple time frames. You're in one tick above the close of the candle, and up we go. Same thing here. 15's down, 50's down, and now the candle is yellow. And the yellow tells us that order flow, stochastic, and momentum are with us to the downside on all time frames. Now we have another color that outlines our candles, and instead of being dark blue, they're outlined in light blue. Or instead of being in yellow, they're outlined in pink. That tells you that you don't have stochastic, you have order flow, and you have momentum. And those are the key parameters. So the outline gives you all the information you need to take the trade without even looking down at the three line. And believe me, when price is moving fast, the last thing you want to do is have to have your crosshair looking over the three line and trying to guess with all three of these lines changing, whether it's going to be all red or whether it's going to be all green. But it's projected right onto the price bars, which makes it really, really easy. And you see this all intra-bar, so what you do is you set a sell stop limit order or a buy stop limit order before the candle even closes. So you have your order waiting there, and if the candle matures, closes, and moves one tick lower, you're into the trade. Here's a break of the modified 15. Same thing. 50's down, 15 is down. You break a trend line to the downside. You can see it's outlined in yellow. Order flow, stochastic, and momentum are with you to the downside, and down we go. Order flow, stochastic, momentum to the upside. 15 and 50 are with you. Always trend trading, never counter trend trading. Now, this is where our software defines market structure for us. The A and the B and the C were not placed on there by me. It was placed on there by our software. Now, an A is printed anytime two candles of the same color occur in a row. That defines a trend. And as this trend moves through, now we can't take a break of the 50 because the price is moving to the short side and the 50 is moving up. And you can see that the 15 and the 50 are different colors. This is momentum to the upside. This is shorter term momentum to the downside. So we don't trade unless we have concordance in color, both red or both green. So we let price action break, and then we wait for a retracement. And this is our bread and butter trade. The price hits a B, and the B gives you an audible alert. And these are people trying to call a bottom or trying to counter trend trade, because what this is an up candle in a downtrend. I mean, the downtrend's clearly defined, but for whatever reason, these traders have decided that this is going to be the bottom of the move, and they've created an up candle. And you can color the B any color you want. I just like to color it magenta. And what we look for, when the B prints, you get an audible alert to tell you that you have a potential trade coming. And then what we look for is the B to be engulfed. And when this trade opened, the C is flashing, and we look for the C to mature to the downside. And you already know that you have a potential C. You know where the C is going to close, and you put your sell stop limit order one tick below the close of the candle, and down we go. Now, these really have a predictive value of 90% or greater. And what makes them so powerful is that the price continues down for two reasons. One, you're in a downtrend, so you have the addition of new sellers. And the other reason is because you're running over all the traders caught in this failed counter trend move. And that's what we try to do with almost every trade. We try to trap traders, counter trend trading, run them over. And when we do, this one tick below sometimes fires this candle down because we're stopping out all the people in the B candle. So we really have two forces going for us: the addition of new sellers and the fact that we're running the stops on everyone in the B candle. And it's really, really a powerful force, because you can actually see it in the way price behaves once you get ticked into a trade. Sometimes it really just fires out 2 or 3 ticks. Here's the same trade again, and you're going to see what we have is redundancy. It's a really simple. There's a lot of components going into the trade, but the pattern that you see is really very simple and recurs over and over again. You have the 50 down and the 15 down. You could have taken the break, but if you did, that's great. If you didn't, you wait for a retracement into the modified 15. We already know that we want that retracement to be 4 ticks or less from candle body open to the 15. Then we see the potential C. We place our sell stop limit order 1 tick below the close of C. And if it hits, bam, down we go, and we run over all the people in B. In this move to the upside, trying to call a bottom and trying to counter trend trade. Same thing again. Move to the downside, and you can see all the people trying to counter trend trade. This is why I say to me it seems just kind of ridiculous. Green candle here. Now we're not in a clear-cut defined downtrend because the 50 and the 15 are both not red. But you can see that we've got a short bias here for sure, even though that we're not in a clearly defined downtrend. But buyers come in and try to push the market up. They get run over. We just don't have the ability to take it short yet because the 50 isn't red. Same thing happens here. Buyers come in, try to turn the market, they get run over. Then finally, we get our trade, the C candle right off the modified 15, and we get our buyers to run over right here in the C candle. So it's all these counter trend traders, these bottom callers, that we run over. And it happens over and over and over again ad infinitum. This is a momentum entry. And you can see the candles outlined in light blue. It might be magenta. You get a break, a retracement right into the modified 15. This is momentum aligning on multiple time frames, many more time frames than the 3-line. We're very big on fractal analysis, multi-time frame analysis, and trading with order flow and momentum. So we let the break occur, and then the retracement back in. We get the confirmation candle up. Remember, we're in a long trend, and it's with order flow and momentum and triple momentum, and we place our buy order one tick above, and we have a buy stop limit. It goes up, retraces again. If we're stopped out, we're back in again, and up we go again. Every time, though, we have traders counter trend trading that we run over. That's the hallmark of what we're trying to do. We're always trying to catch these people in these failed counter trend moves to provide our trade, which is a trend trade with more power. Now this is a momentum entry. It looks like a C candle entry, but actually this candle doesn't engulf this candle. Comes close to, but misses the bottom by 1 tick. But we have the momentum signal, basically the same pattern, and down we go, running over everybody in this failed counter trend candle right here. Again, breaks, retraces, and up we go. With order flow and momentum are both green. It's hard to see the candle outline, but in a clear trend trade in which we retrace back into the 15, we get a bunch of traders counter trend trading that we get to run over on the trade. This is a power entry. It has slightly different logic than the momentum entry, but we're trying to do the same thing. We get the break, the retracement right back into the modified 15 here and the 50, and up we go with order flow and momentum. Here's the power entry. Again, different logic, but we get the break, the retracement, and we constantly trend trade. We get no power entry signal here, but we get one here. We have our counter trend traders here to run over, and down we go. This is a strategy entry. Same thing. Break, retracement, 50's up, 15's up, retrace into support. We take the trade 1 tick above the close of the candle, and up we go. Now here we have multiple signals. We have C candle, strategy entry. We're trading with order flow and momentum, although it's hard to see here. You can see that line 1 and line 3 are green, and up we go twice. Every time running over all of these sellers in this failed counter trend move in the B candle. And here we go again. This was a trade we did take in the room. 37 ticks to the downside. Break of the 15, break of the 50, with order flow, stochastic, and momentum. Went down. We scaled it at 37 ticks. Now, before I show you this slide, I'm going to move over to the platform. So just hold on 1 second. I'm just going to reshoot, and I'm going to show you our trading. Okay, now here's our platform. And let's take a look at how we trade. Now, first, let's take a look at crude oil. We trade this in the room every single day. And let's just go to a time that's not in the middle of the night. And we start trading at about 8:45. So let's take a look at how we do. Now you can see in the upper left-hand corner we have the slope of the 15, slope of the 50. Now you see this number called the MA diff. The MA diff is another parameter that we defined that helps us trade in terms of providing us with a predictive value in terms of an independent variable. If the stochastic is not a number that tells us when the market is overbought or oversold, then what is? Well, it turns out that when the distance between the 50 and the 15 becomes greater than 18, then the predictive value of the trade begins to fall off, i.e. to the downside, the market's oversold. Now, it defines risk. If you want to take a trade with a moving average differential, and those moving averages are the 50 and the 15, greater than 18, then you can. But you already know that that's going to provide you with an additional layer of risk. So we try to keep away from taking anything with an MA diff greater than 18. Now we don't trade anything with a yellow modified 15. Now if we look at this trade here, I can do this a lot easier if I just do this. If we take the break here, excuse me, I'm sorry. Take this break here, let's move up here. This could be a short trade, but the space between the 50 and the 15 is too wide. The market's oversold. Even though it works, it's not a trade we would take. That went 11 ticks. That would have given us a 2-target trade. And then we move to where the MA diff, where our modified 15 is yellow. Now we don't want to take a trade until the 15 crosses the 50. And so we just don't have a trade here. It's a nice move down, but we don't have the 15 cross the 50, so we just don't take it. Now this short trade is launched off of a yellow 15. We don't trade it. And like I said, when we trade with specificity, there are moves we just can't get. Now here's our first trade right here. Yep, the MA diff is too big. It's 27. Can't take it. And this would be our first trade. It's right here. It's the break of the 15. Now the candle's not outlined in yellow simply because the way that NinjaScript works is that fractal indicators recalibrate when you close and reopen the platform, but this was outlined in yellow when we were trading in real time, and this would be our first trade to the short side. We're trading we can trade with a 50 yellow or red, and we've got a red modified 15. And here's our first trade to the long side, right here. There's our C candle. The 50 is yellow. It's only yellow when it's plus or minus 1 or 2 degrees. It just tells you the momentum is not against you. You have a C candle entry, green 15. Up we go. And we have the same thing happen again. Up, retrace, and we have another winner. And that one is 18 ticks. Now we can't trade on a yellow 15, and we can't trade into a pivot. Then here we go again. We have the retracement right back into the modified 15. Here's our strategy entry. You notice we're always trend trading. And now we have a 33 tick trade. Now we can't take this trade. It's a yellow modified 15. and now we're overbought. There's nothing we can do. And on the move down, we never take a short above the 50. Now this occurs on a green 50, so we cannot take this to the downside. Then here, oops, let me do this. I'm sorry, hold on one second here. I'm actually obviously not too nimble with this thing. Let me just delete these. Okay. I just want to at 16, it's really close to oversold, but this trade is going to go 4 ticks, and this trade is going to turn out to be, for our purposes, this would be a loser, because we need to go to 5 ticks for our first target, and this would be the first loser that we found. And I'm not going to sit here and maintain that we never take losers, because we do. I'm just going through the entire trading session. And here's the next trade. The break, the retracement, and then the move down. You see the candles outlined, order flow and momentum. That's 6 ticks, first target. Then you can take it again, right here. Retracement. Have order flow and momentum with you, and that's going to take you all the way to here. 8 ticks. Here it is again. Break, retracement. Oops. Five ticks, our first target, and another winner. And we can go, let's go to another day, start over again, and do it again. And here's our first trade. It's a 902. We're in 1 tick above. Let's say we only go 18 ticks and we stop out. We're right back in on the next C, right here. For 13. Then we're in on the next C, right here. For 12. And then we're in on the next one. This may be overbought, and this may not be a trade I would take, this 26 tick trade. Usually I'll only take 3 retracements. But I kind of think you get the idea that by trend trading, looking for defined retracements into a trend, always trading, you see every one of these candles. This is outlined in order flow, stochastic, and momentum. This is outlined in order flow and momentum, order flow and momentum, order flow and momentum. The 15 is up, 50's up, the 15 is up. And we always run over the counter trend traders in these B candles. I mean, that's the name of the game. Now, there's one other thing. This is called our bias indicator. And it's really, really effective. And what this is the only indicator of its kind that I know of in existence. And what it does is it analyzes market structure on multiple other time frames. And what it tells you is when market structure is set up for a long. Now, one component of it is it tells you that on multiple higher time frames, you've broken all resistance to the upside. So when you take a long trade with green bias, you know that you don't have to worry about trading into a trend line, trading into a moving average, or trading into a pivot. The indicator tells you, without having to look at multiple time frames, that you're clear to the upside, and it's a-okay to trade. And that's the reason why you may, if you wanted to get a little riskier, take this trade here. Now the 50 has not yet crossed the 15, and normally we wait for it to cross. But when you get the break and the retracement, like you have here, and you know that you're with the trend, 15's up and 50's up, and you're trading with order flow and momentum, and you have the background bias. In other words, there's nothing to prevent this trade from moving to the upside. This is a breakout in essence, but you're taking a retracement without any overhead resistance to bother you. This trade's going to go 7. And here's our bread and butter trade. This is the kind of trade that when we see these, honestly, we salivate over. It's these. 50's just crossing the 50. We get a retracement right back into the modified 15. Here is the king entry, the king short, right here. And down we go for 23 ticks. And you can see we're trading with order flow and momentum. So what we do is we get indicator confirmation of market structure analysis. That's what gives us a predictive value of greater than 85%. And in looking through this, here's a loser that I took. And it even had short bias. And I want you to know that there are occasional losers. You can't, I don't want you to think that they don't occur. Because if I told you that, you'd know I was giving you a line. And they do. Here was another trade we took. I took it in the room. We went down for 8 ticks. We got a 5-tick first target. And I can kind of do this forever. What I would like to do, I'm just going to show you the ES really quickly, and then I'm going to show you our direct entry system. Let me just show you the ES. And then after the direct entry, if you have any questions, I'll answer any questions that you have. Now, the ES has been really miserable to trade. It just hasn't had any volatility. But here was our trade. There's the retracement. And this trade went up for 1 point. There's the retracement. And there's the move right here. And up we went for 5 points. And this was the whole day. Those were the only 2 trades of the entire day. I think there was one other trade. Let me see if I took it here somewhere. I thought I took, but there was one other trade. There was nothing else. And here it is again. Every day we see these trades. This isn't early in the morning. I don't want to point out trades that occur in the middle of the night or early in the morning. Okay, this is a trade we took in the room, in the trading room. This is the trade we kind of salivate over. 14 ticks. That's 3.5 points. Down we go. The retracement right back into the modified 15, and we have background bias to tell us that we have no support to the downside to break. This is a trade I took in the room. I didn't have background bias, but it's a perfect retracement. 15's down, 50's down, and this went for 2.5 points. This was a loser. This is a winner for 4 ticks. Okay, now what I want to do is I want to show you our direct entry system. Because I can show you, I mean, we obviously are going to get occasional losers, but I want to show you how we take our trades. If you just hang on 1 second. I'll put it up anyway. Or just activating it now. Okay. Let me move this over here. First. And put my ES chart back up. Just waiting for it to connect. Oh, okay. You know what the problem is that the market's not moving, and we have to have market movement for it to connect, which is really a shame. I can't exactly show you. I can't show you how it works in real time. But what the direct entry system does is this. When I call a trade in the room, I enter it on the direct entry system. The direct entry system allows me to insert that trade directly into your NinjaTrader, so that, let's say you step away, let's say it's a late call, I call it quickly. Well, I hit the buy, I hit the sell, it automatically gives me the buy sell stop, or the buy stop limit or the sell stop limit order on the candle that's forming, and it enters that trade directly into your Superdome. If I don't like the trade, I can close it. If I want to get out of the trade early, I can hit exit. So basically, I almost do complete trade management right from the direct entry system. So by coming into the trading room, I mean, we have such confidence in the software that we not only call the trades, but we actually insert them directly into your NinjaTrader Superdome, and we also do about 80% of the trade management on the trades for you. And we've added a lot of components to that, but I don't want to get confusing. So let me just put the slides back up and just finish up with the slides, and then I'll take the questions. Let me just scroll through these. Now, cumulative live trading room through September, we're up about $40,000. And that's trading 4 contracts. On a percentage basis, that's 1,000%. Now we have an auto trader. For a while, it traded 3 contracts, then now it's up to 4. It's up to about $20,000. On a percent basis, that's up 500%. Now, this is just from 9/22 through 9/30. We have the website updated, but I had 2 losers, and I think I had 27 winners. And we booked $4,080 in profit. Now, these are all trades entered directly into your Superdome with the direct entry system. Not late calls, not retrospective calls. These are direct calls that I made in the live trading room. Now, 10% of trading is discretionary. you're going to see that when you get a little bit of experience with the software, you have a little bit of leeway in what you can do. And we provide you with extensive videos, group and personal mentorship programs. We really support our software, which by the way works incredibly well. And we never ask you to pay for boot camps or seminars or lectures that we have. And the big thing is, and we've upgraded our indicator packages so many times, we never ask you for free for more money for indicator packages for upgrades. When we got the direct entry system, we gave it out to everybody who owned the software. We're very soon gonna come out with an E-mini S&P Auto Trader. When that comes out, it's going to go out to everyone who owns our Auto Trader system. We never charge for new things that we produce. We wind up making them an additional cost to people who are not members of Rightline. But if you're a member of our family, you always get everything as add-ons and upgrades. They're all yours just for joining us and trusting us. And I don't even know what a boot camp is. I mean, if you can't buy the software and get the educational support you need to become a profitable day trader, I have no idea why you would pay $500 or $1,000 to pay for a boot camp. To me, a boot camp acknowledges that you failed in what you set out to do, and now you're asking for more money to set the traders who are not profitable straight and show them their mistakes. And we do that for you for nothing because we want to make you profitable. As part of this webinar, we're going to offer you a special. Now, the Rightline Trading software package and all the video tutorials, plus the direct entry software, where we enter the trade for you right into your software. And normally, we don't offer it for ownership, but we're combining them. And this is a lifetime ownership. 2 hours of personal mentorship, and 2 months in the live trading room for $29.99. Normally, we never sell a direct entry, and the software is $34.99. Now, we also encourage you to do is to please sign up for a free trial to our live trading room. We're going to drop the user. Well, you need to go to www.rightlinetrading.com. There's a link. If Leo can put that in the room, we're going to put the link in the room. Okay, well, we can't put it in the room. Just go to rightlinetrading.com. There's a link at the top of the page to sign up for a free trial. It's real easy, and come into the room and see how we trade. And I think that is going to be the best ticket for you to see how effective our software is. You can call us anytime at 855-765-6681. So I got time for just a couple of questions. And let me see how I look at those questions. Hold on 1 second. Okay. Hold on 1 second. Let me just get the one question at a time here. Muhammad asks, does the system work on a 60-minute chart? Muhammad, it works on any time frame. We have people trading 60-minute charts, 4-hour charts, 8-hour charts. We have people trading daily bars. The time frame doesn't have as absolutely totally unimportant. The same thing that you see on an 8 range, you're going to see on a 377 tick, a 610 tick, 4-hour bars, 1-hour bars, daily bars. It makes no difference at all. We don't have the software available for Metastock and TradeStation, but we're soon going to move to Sierra, and then eventually to Metastock. Right now, the only thing that it's available for is NinjaTrader. Any other questions? All right, well, listen, I really thank you for, again, I thank Darla for hosting me here, and at Trader Planet, and I really, really appreciate um, the time she's given me, and I welcome everybody to come into the room and and check us out for a free trial. So everybody have a really wonderful evening, and I look forward to seeing you in the trading room. Take care.